The markets dropped today. Are we going to have 2 days of declines, 3 days of declines? I'm going to talk about what our expectations are for this pullback and how that impacts the intermediate posture that we're currently on and how long it can last. I'm going to break all that down in tonight's video. Today's trade idea highlights a pattern that we're seeing across a bunch of stocks. So I'm going to use the example tonight to focus on that pattern to show you how to trade it. Let's go ahead and get started. Today is Wednesday, June the 13th, 2018. This is the Market Outlook from MarquetteScholars.com. My name is David Settle. Thanks for tuning in tonight. Welcome to those of you who found us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Marquette Scholars logo in the bottom right corner of this video. Click the red subscribe button that pops out there. Like this video if you found it useful, if you want us to keep doing it. Comment on anything that stands out to you. Join our daily Market Outlook email list with that link that's popping out in the top right corner of the screen. Click that link and you'll be able to subscribe. Follow me on Twitter for more content like this. Join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 with the market forecast indicator first off here, and you can see down day today. Most of that selling, as you'll see here later, coming after the FOMC announcement. The momentum line fell to an extreme low point, so fell below the 5th percentile. Hasn't done that since this low point here. These extreme lows can signify potential bearish posture change, or at least because we're bullish right now. It signifies posture changes, so because we're bullish, the posture change would be to bearish. But keep in mind, considering how strongly bullish we are, and any posture change we do get would be weakly bearish, and it wouldn't come for a while because of how high the intermediate line is. I wouldn't put a whole lot of stock into that extreme low point. And the reality is, you've got the near-term line below 50 setting up for a potential bullish near-term bounce. Now, here's the Fibonacci retracement lines of this current near-term run that we're on. It lasted 10 days, and you see, as bearish as that posture looks here, it still doesn't even, this pullback didn't even get to the 23% Fibonacci retracement. And I'm not talking of the intermediate rally, which actually would draw the Fibonacci lines from down here. I'm just talking simply of this current near-term run. So, context is key in a lot of things we look at, and that just kind of looks at today's move and says, okay, that's not that big of a deal. And in fact, it's, we might get another day or two of selling, maybe eventually down to this 2750 area where the 38% Fibonacci is, or at least to that 2765 area. And then look, depending upon where the near-term line ends up, we would look for a bullish bounce like this. It would be higher, obviously, than the last near-term low point right here. And we would expect a bounce up to new near-term highs, potentially up to this high point, the all-time high. See, we kind of stalled at this high. And the next high would get to there. So, and another thing too that stands out, at least on this chart, is number one, our 3-month returns are not extreme. So it's not like we need a big bearish move right now to correct some overbought conditions. So that's number one. And number two, you notice today's range was well below average. So when you start getting above average ranges, that's when you start worrying about how bearish we might be and a change in trend. So, because that ATR is going to get lower and lower and lower as we go more and more bullish, so it won't take as much of a move to get a bigger than average range. So multiple things here kind of throwing a little bit of cold water on today's rally. It's not that big of a deal, or today's pullback, as of right now, not that big of a deal. You can see the Dow Jones Industrial Average, the momentum line actually was down to an extreme low point yesterday. But again, you look at this move, and that does not look like an extreme pullback, right? The near-term line is down, setting up for a potential bullish near-term low point off of the last near-term low, off a higher low, higher than the last one, which happens to be down here. So you can even see we're still shaded green, even with today's down day on the Dow. And of course, looking at these others really quickly, the NASDAQ composite, The Nasdaq is this is something I've brought up in classes that I've been putting on here at Marquette Scholars, and that is this idea of a divergence setting up, at least the potential of that divergence setting up on the near term line with what's already now a higher high comparing to lower near term highs. Again, I don't necessarily think that this is going to be like all of a sudden a big bearish change in trend. But again, a pullback down to at least 7,600, which is the low point of the divergence, could set you up for another day or two of selling, which would not be the end of the world. You can also see that's about where the old high point was on a closing basis over here in March. Finally, the Russell 2000, same divergence, lower highs in the near-term line, higher highs in the index. Yes, I have a bullish intermediate confirmation signal just like on every other one, but considering that this is not that big of a drop today, and the idea of that divergence, we could get again another day or two of selling before the intermediate posture resumes itself. And we are a little past with this intermediate trend started back in early May. Well, for the Russell 2000 started back here in mid-April, so we're 2 months now into this intermediate move. Whereas in the S&P 500, this one did start back here in early May. So we're over a month. We're getting to a month and a half. 2 to 3 months is typically how long. Now it won't be 2 to 3 months of straight green, right? It could be a little light pink in there, which means the posture turns weakly bearish, but doesn't drop below 50. That's okay. That doesn't necessarily change the run. The 2 to 3 months can include moves like that. So when it gets dark pink, that's when the intermediate run is over, right? Because that's when the intermediate line drops below 50. Okay, before we look at the rest of our charts, I wanted a quick reminder for those watching on our blog today, marketscholars.com. Again, the address is marketscholars.com, and click on blog. If you're watching the video through here, and that's how you got the link to tonight's video, underneath tonight's video, you'll see this link and this tweet that I put out with information on why you can join our Marquette Scholars site during this early access beta period with the discounted offer. So there's the link to do so, and then this link down here in the Twitter feed will take you to this email address that will kind of give you some information on what we offer currently during this beta period and why we have this discounted offer that ends actually at the end of the month. So here's a link that will take you to current Marquette Scholars and what they are saying about why they signed up early and what they have gotten out of it so far. So if you want to click on that link and read straight from the source, and that may answer the questions about what you may get out of it by signing up yourselves. All right, let's go back and take a look at the charts again. You can see the long-term chart still, that's what today's pullback looks like on the long-term chart. So very, very small relative to that 10. There's that 10-day near-term run that we've had on the S&P over that 2-week period off the 50-day moving average. So again, context is key on everything here, and the trend, we're still above a rising 50-day moving average, and the 50 is above a rising 200-day moving average, and the gap between the two is getting bigger according to the MACD. So again, still bullish from that perspective. Looking at the 3 green arrows, shaded green here too. Yes, the MACD has rolled over and has turned down, but we still have same with the stochastics, but they're still showing 3 green arrows. Now, if you notice, today's pullback didn't even break the 8-day moving average. So again, another context in terms of how bearish today was. We closed below the low of the high day, if you want to call it that. But again, the MACD is above its moving average. The stochastic's above its moving average, but both of them are above the 90th percentile. So as bearish as that is, it's if we do want to say today was a bearish day, it was about as weak of a bearish day as we could have, according to these intermediate and long-term charts. All right, if you take a look at the intraday chart, you can see, obviously this looks a lot more bearish. Look at all the selling coming in at the end of the day. So all of today's volume was mostly selling, especially here at the end. Ended up closing a smidgen below yesterday's low point. But look at the ranges compared to like the 4-week range, and then where we are relative to the 4-week range. And again, the Fibonacci retracement areas and where they are relative to, here we go. So get it up here, and let's see, snap this to open, high, low, and close. Activate that again. So we'll snap it there, and then we'll snap over here to 26.76. There's 267.76, excuse me. So there's our 23% Fibonacci retracement. It would get us down to last Thursday's low point. That's why I say there's another day or maybe two of selling. Of course, the 50% Fibonacci retracement, of course, is the 4-week midpoint, because that's the 4-week range is this current near-term rally we've had. So there's which also ends up being a support level from these old high points as well. So yeah, we can get another day or two of selling and not be concerned at all with any kind of change in intermediate trend other than just a near-term pullback. And you can see where that pullback may come down to if we were to get that next day or two of selling. So remember, I told you that the range was below average. You can see the range is still in that bullish area below 1%. And the volume too was slightly above average today, but not as strong, not very strongly above average. You can see that here when we look at the 3 green arrow chart on the ETF. Again, a lot of that selling coming at the end of the day, and most of today's volume selling and slightly above average, but again, that average is pretty darn low. And then finally, volatility bounced up today and didn't even get to 13, so it can still go up to a little bit past 13. When you compare volatility to its previous high point, which is right here, and then before that, the previous high on the MACD and stochastics is way up here. So, and of course, 15 would be another level that has volatility. The VIX has used as a support or a resistance in the past. So again, we rallied up, but we didn't even get to the neutral zone today. We're still solidly in bullish territory. So again, another day or two selling, you might get up into this area where the volatility will find some resistance in the short term, and again build the case for a new near-term bounce after another maybe day or two of selling. So to summarize, the posture remains strongly bullish. We had a down day today. It was not that big of a down day today, and there's maybe another day or two coming even after that. So what do you think? Do you agree? Do you disagree with the market? The technical analysis we've done for our market posture today. Click the poll that's popping out in the top right corner of the screen there. If you click on disagree, comment down below on what you're seeing that might make you a little bit more bearish than what we may be expecting over the next couple of days. All right, now let's take a look at what's driving the price action. And you can see over the past 5 days, crude oil has been the one outlier to the upside and emerging markets to the downside. Of course, today's news was the FOMC. That was the biggest mover of the markets as soon as we hit 2 o'clock Eastern time. And you can see the U.S. stock market, the S&P 500 was the biggest loser. Bonds were down, so yields rallied after the announcement, and the dollar rallied too. So that's not a surprise considering the Fed raised interest rates here. Here we go. Well, you can see it over here too. Right here, you can see the Fed raised interest rates to this 175-200 level. That was for the June meeting, of course. The September meeting, you can see the odds of another rate hike in September jumped up from 70 to 80%. So the 81% chance, or 82% chance, that we're going to get another rate hike in September. And then, of course, getting that third rate hike in December, or the fourth one for the calendar year in December. The odds have now gone past 50, up to 55%, over 55%, over 56%. So the odds, so big jump up in rate hike odds is as the chairman, Powell, talked about, that the neutral rate of where, the interest rate will neither be restrictive or accommodative is probably in 4 more rate hikes. So that would be, obviously this one, 3 more, and 3 more, and then there's 2 more the rest of this year. Another interesting tidbit that came out of the meeting was, starting in January, there will be a press conference at every meeting. So now they won't make a rate hike decision anymore without a rate. Now they can start making rate hike decisions at every meeting. It was an official policy to not make any kind of rate hike or rate cut decision at a meeting that did not have a press conference, but that's kind of how it turned into, with all these rate hikes to get to this point, from 0 to 0.25, to get to 1.75 to 2. They've only done it on those quarterly meetings that's lined up with these press conferences. January, now you might start getting these potential decisions at every meeting. Now, granted, and you can see from the dot plots here, so 2 to 2.25, that's this range here. So you still have half of the FOMC, with the idea that we'll have that we'll only have 1 more hike, and then the other half looking for 2 more hikes by the end of the year. And again, the idea being that we'll get 4 more hikes before we get to neutral range. Well, that's 1, 2, 3, 4, and that's where the consensus is for 2019. That will finish the next calendar year with 4 rate hikes by next year completely. So that would be 2 more left this year, September and December, and then whenever they decide to do the next 2, and it could be January and the month after that, or the meeting after that, to get to eventually, what would it be? So we have 1 more, 1, 2. Actually, let's see, 1, 2, 3, 4 to get to. It would be 2.75 to 3%. Would be the range where the consensus is, and you can see looking for 2 more hikes in 2020, and then there's your longer term rate. So the longer term rate, that's kind of this neutral area of where the Fed's anticipating. And the other interesting tidbit that came out of today's press conference was, yes, inflation is running pretty high right now. And they view it as this being temporary due to energy prices. You can see the core rate's running above 2%. That strips out energy, but can be influenced, of course, by energy. And of course, the PPI, which came out earlier today, the core rate is also above 2%, but not rising like the headline is. So you can see some core, some energy influence there. That's not in the the core rate. If you take a look at what's interesting moving today, again, you consider the inflation figures, food and energy, and you can see how strong energy has been over the past week. If I were to look at the past week, that was the last 5 days, energy has been the biggest winner. But agricultural commodities have been the biggest loser over this past week, and that continues to be the case today. And emerging markets also struggling today, and there's your S&P, there's your U.S. stock market pulling down. Whereas on the upside, the only thing really that gained ground significantly was crude oil. Everything else pretty flat coming out of today's anticipated FOMC meeting, and for that matter, pretty flat coming out of this week's news events, that we had with this North Korea-U.S. summit yesterday, and then the FOMC here today, and a big basket of economic data so far to get to this point, including inflation data, which is hot button issue. But then tomorrow you'll have retail sales. Here will be an inflation type figure that we'll keep an eye on, and then on Friday, industrial production and Empire State Manufacturing. And Treasury International Capital. So a few things that we'll keep an eye on as well. So a busy end of the week developing for us here. What's interesting about this pullback today, especially here at the end of the day, and you can see over here how things performed just today, including the opening gap. Discretionary held up well. There's your safe haven sectors. There's the S&P 500. So everything outpacing the S&P were your safe haven areas. Financials benefiting a little bit, just barely, but a little bit from the rising yields, and of course crude oil rising, helping energy a little bit. On the other end of the spectrum, look at what the rising yields did to real estate, really tanking it. Materials and telecom also kind of the real interest rate sensitive area also has some issues going on there in that industry, right, with the mergers going on. But you can see materials and energy, economic growth sensitive areas really lagging behind by double the market's loss. And of course, technology a little bit too. So, I mean, you can see them all down here. This is over the past week. You can see there's real estate, there's materials. This is financials. Even with the rates rising today, there's technology. The blue would be industrials. Here's energy, all dropping. Whereas staples, for the most part, over this past 5 days, past week, has been held up its value. In fact, still up 3%, where the market itself is flat for the 5-day period. And then, of course, you can see the other, there's the other consumer area, which is, we got retail sales coming out tomorrow. So it'll be interesting to see how those are impacted. And then you can also see, too, utilities, a safe haven area, along with healthcare, which can be there are industries within healthcare that are also considered safe haven as well. Safe haven holding their value while the market's been kind of up and down a little bit over the past 5 days. All right, on a day like today when you get pullbacks or short-term pullbacks, you get patterns like this that you see on the market forecast on a lot of individual stocks. This is an intermediate confirmation signal. Remember, the consumer staples sector is one that's been holding up well over the last week. You can see Procter & Gamble here, like that consumer staples sector, starting to be bullish. It hasn't, the sector itself is just starting to get that intermediate line close to the reversal zone, starting to turn green. Market sentiment just getting out. I mean, it's been so beaten up for so long. It's rare for market sentiment to get below 20. Look at all those oversold clusters we got, and we finally finished here and have turned up. We've got a green shaded area with a rising moving average. We haven't had this condition here since back here at the end of 2017, beginning of 2018. So a long decline for this particular stock during the market downturn. You can see, looking at the 3 green arrows too, PG, you can see again, that's the last time we also had, shaded areas in green, and that's what we're getting here again. 3 green arrows with a rising moving average. And then, of course, not quite there on the golden cross. We still got a long ways to go. But at the very least, getting up above its 50-day moving average, which you kind of have to do first. Now, you can get up above and turn back around when you hit that 200-day moving average to come down. So we'll see if this is this kind of pattern here or this one. If it ends up being this one, you have an opportunity for a good bullish trade. Even whether you buy the stock or even if you just look at the short for 37 days out, selling the 75 put and buying the 72.5. If you take a look at the chart for P&G on the, where's that $75 at, and you can see during this current near-term rally, which I've got with the blue line coming up from below 50 and getting up to the reversal zone, now finally pulling back. So here's the buy signal, right? Bullish intermediate confirmation signal with the overbought, with the strong bullish posture, oversold momentum line, the near-term line down into where it can be a bullish near-term low. Now we can drop a little bit further here, but you notice there's 75. 75 is at the bottom end of the Fibonacci retracement zone. There's also an old high point over here at 75. So as long as we hold that old near-term high point for support and that Fibonacci zone as a support, then great. We bounce up off of this and we keep moving higher. And you can see if I were to analyze this trade, as is, we have about 67% probability of success for a decent credit on a $2.50 wide spread, going for that $58. And you can see for me to lose $58, I'd have to go past 74 to get to this a little bit under 74 area. So we have about to where my cursor is there before now I would lose as much as I'm trying to make. So I can position size, in this particular account for 1% risk, $1,000 risk. One contract's almost $200, so I can go up to 5 contracts here, and position size for $1,000 risk. Knowing that, again, trying to make about, what would that be, 200 and for $960 of risk, going for that $290 gain. And then again, the $290 loss would be right in this area, right below the 74 area at that juncture. If we were to break support at 75 and get into this area, then I would take the small loss, move on to something else. All right, so what do you think about today's trade idea, and what do you think about today's market posture? Let's chat about it in our Marquette Scholars forum. There's a link popping out in the top right corner of your screen there. Click on that link, subscribe to our site, and participate in our forums. And let's any questions or comments you have about today's video, any questions or comments you have about the trade, let's discuss it there. As always, thank you very much for watching. I appreciate your time this evening. Again, those that are watching us for the first time, glad you found us. Let's try it again tomorrow. Have a great one. Remember to subscribe to our channel, like tonight's video by clicking the thumbs up icon, comment. Also follow on Twitter for more content, and join our Market Outlook community on Facebook. Have a great one, everybody. We'll see you all next time.